While a lot of investors eagerly await those Alibaba shares, if you can get any of them, there's a number of other stocks not getting a lot of love that appear to be priced maybe beyond perfection. Dominic Chu tells us now which big-name stocks are seeing maybe some bearish outlooks and whether investors should avoid them or maybe see them as a buying opportunity.
There are around 30 stocks in the current S&P 500 index of large-cap companies that have an average analyst target price that predict at least a 3% drop from current levels. For instance, there's Kellogg, which makes some of the most popular cereal brands in America. Analysts who cover Kellogg stock have an average target price of around $63 a share. If they're right, that means a possible 3% drop for those shares. Some experts blame changing customer buying patterns for that particular weakness.
The push, the negative is that these are, in the past 14 years I've been doing, is some of the worst fundamentals these companies have had. With Kellogg specifically, a 5% decline in the cereal, 4% in their cereal business in the second quarter. Very discouraging as consumers seek other kinds of foods.
On the other hand, some stocks have staged huge upside moves. That's the case with athletic apparel maker Under Armour. Shares have gained an eye-popping 65% this year. Analysts have a target price that's currently 6% below its current levels. And the S&P 500 company that could fall the most based on analyst target prices is office supply giant Staples. It's had to deal with stiffer competition from the likes of Walmart and Amazon.com. Analysts think that this stock could drop by 12%. There are a number of factors that analysts look at when putting together an investment view.
First of all, I'd have to see a deterioration in the fundamentals. That is, we'd have to see that growth prospects are disappointing or that we saw concerns about the long-term business model sustainability. Secondly, it could simply be that valuation has reached an extreme level. It could be that it's either fully valued or well above the prices that we forecast either for the industry or for the sector. And then lastly, it could also be a particular vulnerability at the point in the business cycle.
Analysts are always looking for reasons to change their target prices or investment outlooks. Now the question becomes whether enough has happened for these companies to make the tone more positive. For Nightly Business Report, I'm Dominic Chu.